Welcome back. You're watching Market Makers. Correction or crash, and we are in conversation with three men who matter the most. Rashesh Shah, Chairman, Edelweiss; Dinesh Thakkar, Chairman, Angel Stockbroking; and Nirmal Jain, Chairman of IIFL. Rashesh, what should be a basic approach for next 12 months now? Focus on fitness and don't focus on portfolio fitness like you always do?
No, I think especially at times like this, I think investors should be very focused on being clear on their investment strategy, philosophy, and that clarity is more important because you don't want to get shaken away by all the events that are happening around you. I think maybe over the next 5-6 months, I think an asset class that is now coming of age but has been ignored historically by investors has been the corporate bond market or the fixed income market. Because I think given the fact that even a government 10-year treasury bond is giving you 8.5% interest, and if at all there is going to be economic growth back in India, if at all equity markets go back into optimistic mode, it will have to happen when interest rates start coming down. If it is so, then I think being in bonds or other fixed income instruments might be a good idea. So I think our thing is investors should look closely at the next 5-6 months to be in those kind of instruments, and then use this also to use any correction, sharp fall in the equity market as an opportunity to allocate money away from bonds into equities. So I think it could be a good strategy because it's going to be a very good time to invest in equities over the next 5-6 months, but there is no hurry. Investors can pick their time and in the meantime also take the advantage of the high yield rates offered by the bond market.
Nirmal, so for next 6 months, which is a better instrument? India Infoline stock or India Infoline NCD?
As I said that we approach a balanced approach, so you have to have both.
So buy the stock as well?
See, nobody can foresee the future and there is no digital answer to the portfolio question. So you always have to have a mix of it because every analyst or everybody will predict the market with if and but, with certain caveats here and there. Nobody is very sure of what's going to happen tomorrow. Nobody can be. And from that perspective, it's always a good idea to have a mix of it. But you can keep changing the allocation. So sometimes when as Rashesh was saying that you can have maybe more allocation to debt and you increase allocation to equity when you get more comfort on equity side of it. But as I said that I think more and more Indian investors will have to change their approach towards investing, and rather than 0 or 1, you have to have a mix of both, and always you can vary the percentages, but you can never get out of an asset class completely.
Dinesh, where in the mid-cap space is a compelling value argument where you are absolutely convinced, Dinesh, that it makes sense to be a buyer and you are ready to bet your family silver to buy those mid-cap names?
See, first of all, to have a very huge exposure on mid-cap is a wrong strategy. As I always say that investor, when he's building a portfolio, he has to keep in mind that mid-cap and small-cap should not constitute around 15 to 20% of his portfolio. So one clear-cut advice is that when investor is doing direct investment, he has to mirror composition in indices, benchmark indices like Nifty or BSE. Major deviation from there, investor will suffer a lot because even experts find it difficult to beat benchmark indices. So hence my clear-cut advice would be that be focused on large cap stocks, and in mid cap if you want to invest, you should invest in leaders. As I told that few of the names that come to my mind is in print media, Jagran Prakashan, in agrochemical, United Phosphorus. So there are lots of stories, but I think for investor it is important when he has decided that he wants to go for small and mid cap, he should take a professional advice. He should go for mutual fund route so that fund manager is tracking that companies. Because it's very difficult to really predict the trend in that companies. It can change overnight. So to switch and balance this kind of portfolios, I think it's very tricky. If you look at last, say, like 4 years suffering that investors are going through, it is mostly because of their attraction. I would say fatal attraction towards small and mid cap. Today, these benchmark indices are just 10 to 15% down from the top. But if I had to really construct an index where investors have invested, I think that would be almost 60% down. So again, a word of caution for people who are investing in small and mid cap, that if you want to invest, go through professional route, go through a fund manager, portfolio manager, or through a mutual fund. But if you're investing directly, it is better you go for large cap. And it makes better sense, at least in this kind of valuation, to go for market leader large cap stocks. So I would clearly underline that people have to go for companies like Reliance, L&T, Axis Bank, HDFC Bank. They can't avoid this large cap. 15 to 20% of their portfolio can be in small and mid cap.
Nirmal, we get a lot of emails on this subject. What should I do with my leverage position? So what should traders do in a falling market, and should they get out of all the leverage positions?
I think a very rule of thumb or a very base answer is that yes, you should get out of all your leverage positions. There's not a market that you should be leveraged and play the market in this manner. When there's a more stable market, traders can take some leverage. But in a market like this, when the interest rates also have gone up, it's a good idea to get out of leverage, more or less completely.
In the mid-cap space, Nirmal, where do you see a deep value argument?
I think if you have a 3 to 5 year horizon, then there are lots of mid-caps with deep value. In fact, the entire sector is deep value. You can look at the indices also to start with. But if commodity prices soften world over, then what will happen is the global cyclicals will do well, but global cyclicals will not do well, and domestic cyclicals will do well. So stocks like metal and all those will be under pressure, but you have stocks like cement, auto, or even banking sector, so they will start doing well. If you want to look at mid-cap stock, one should also look at IT stocks. I think IT sector has reacted maybe a bit overreacted today. I don't think that the problems in US or Europe will make too much of an impact on IT companies, because the corporate sector in the US or Europe is still doing well. So there will be opportunities in IT sector, there will be opportunities in pharma sector, and also in FMCG sector in this environment. And if you want to take a bit of contrarian bet and have at least 3-year perspective in mind, and you can also look at sectors like cement and banking.
Why are you not hot on commodities, Nirmal?
I think that the way things stand globally, I don't foresee a very high possibility of QE3, given that even this debt rollover or the increase in the ceiling was difficult for the US government. So under this kind of environment, and plus the growth is slowing down all over, so I think commodity prices will soften now. So that's the key reason.
Rashesh, how are the dynamics changing for the brokerage industry, and especially how is Edelweiss planning to position itself in this kind of murky scenario?
I think, as I think anybody who reads newspapers and has been following, all the media reports, knows that the brokerage industry is going through a hard time. I think that is very obvious, because I think the product mix has changed. There is a lot more options and futures as compared to cash equities. I think the yields have been coming down. Costs obviously have been going up. So the operating margins, which were close to 30-35%, have for good scale efficient players have now become between 5 to 8%. So there is a huge compression in the operating margins in the business. And what we will see is, I think, 3-4 things. We will see consolidation in some form or the other. In India, it's not just through M&A, but I think through scale down, a lot of people will exit the business. We are starting to see that, and the current year is going to be a very painful year for the broking industry. But I think what could be an opportunity, if you truly believe that this is a cyclical trend and not a structural change away from the brokerage industry. I don't think the brokerage industry has structurally completely gone away. But I think cyclically, currently it is under stress. It could be an opportunity for people to invest, strengthen, maybe acquire, inorganically grow, if you have the staying power and the capital base. And I think thirdly, what brokerages are doing is expanding into other activities like credit and wealth management and others, so that you have a fair amount of diversification across that. Like in Edelweiss, we now have capital markets, credit, asset management, insurance, and housing finance as the 5 business verticals that we have. And capital markets, which 3 years ago used to be almost 80% of this, is currently about 35-ish or so. So I think the idea is to reduce dependence on capital markets as such and increase it in other adjacent markets like credit and insurance and housing finance and all. So I think firms which have capital base, which can broad base, which can invest in this, will be able to ride down these cyclical downtrend that we are seeing in the broking industry. So the cyclical downtrend is, I think, fairly painful and will continue to be for the next 3-4 quarters.
Nirmal, most of the brokerage stocks as we speak are trading either sub-book or almost at their book value. And historically, every time brokerage stocks have come back to these beaten down levels, they always classify as a good buy. Is it too early to buy brokerage stocks?
No, I mean, being a promoter of a brokerage company, it'll be I won't like to comment on whether it's too early to buy or sell, because it's something which is every investor, I mean, the basic disclaimer always is there. But I look at, as a promoter, I think, I'm always an optimist, and like Rashesh, I share his views that the industry is not permanently, it's not a business model which is broken. I mean, it passes through cycles. It has passed through cycles after Harshad Mehta crash in 2003-04, when even in two-hour market brokers had time to come out and have Bhelpuri. Then you had times like, after Ketan Parekh, again, there was a bit of a long lull period. So this industry by nature will pass through such cycles. And fortunately for most of the brokerages, in a good market of 2007-08, most of them have raised capital. So they have very strong balance sheet and they have capability to get into other financial services businesses. Many national brokerages, they have now footprints all over the country. So they will survive, and I think once they emerge, survivors will emerge stronger. Having said this, also look at it from a macro perspective, that India's economy today is about, say, $1.3 trillion, which will be $4 trillion in 10 years' time. No way market cap to GDP ratio will change in such an adverse manner that industry will always continue to shrink. So if the market is, the GDP is going to grow 3 times, and maybe more so in monetary terms, I'm talking about real growth, then more likely scenario for a growing economy like this is that market volumes and the market size will grow even more in terms of percentage or manifold growth. So given that kind of a scenario, quarter to quarter is always difficult to forecast what will happen this quarter versus next quarter. But if you say point to point, you look at it today, and if you are talking 5 years later or 10 years later, right, the industry would be, multiple times what it is today.
Nirmal, I know I've extended my appointment with you, so let's get your final thoughts going. Current market environment, correction or crash?
Correction.
Dinesh?
Hello? It is in correction.
Rashesh?
Yeah, I think it will be correction only.
Okay, we've got some consensus going on that consensus. Let's take a break. When we come back to look at individual businesses, Nirmal, appreciate your time. I know you have a board meeting to attend, so thank you for accommodating this interview request. In conversation with Rashesh Shah, Chairman, Edelweiss, and Dinesh Thakkar, Chairman of India's largest retail broking, Angel Stock Broking. Dinesh, we've discussed Indian micro. Let's look at global macro. If US loses the AAA rating, how will that change life for you?
Definitely, there will be some impact. But take it this way, that what are the options available to debt dealer? Because almost 50% of the exposure is of US bonds. So I feel that, first of all, their currency will depreciate, which is good for US. Because their exports will increase, their indebtedness to other countries definitely will reduce. So I think it's the right step for US if they want to repair their economy. They have to take steps, and they must be ready for this kind of a downgrade. If the downgrade is going to help, it will be a blessing in disguise for US. But as I told that, for US it is important with such a kind of a trade deficit. They can't afford to be importing more than export. They can't afford current account deficit. So I think initially there will be a knee-jerk reaction, but in the long run, US would really feel that the steps were necessary, and in one sense, it will help them improve their economy. See, today lots of unemployment is there in US. So in one sense, if they're able to get an depreciation in currency, that is a problem in Eurozone. This Greece having a problem is unable to depreciate their currency. But fortunately for US, I think their macroeconomics factors are very favorable. Their median age is good. Their debt to GDP is just around 100, 120, not unlike Japan or Europe. I think it is a matter of time that if this happens, that US will be in a strong wicket. It may take few years. But one more benefit that an emerging market will get, as I told you, that we are going to see benefit because their consumption will reduce. and they will be focused on really creating a fundamentally good story for US again, which in the long run would be good for a global economy.
Rashesh, I'll blend my questions into two. First, what will happen to EMs if US loses the AAA rating? And B, between US and Euro, which is a bigger problem?
I think the second one is an easier one. I think between US and Euro is a bigger problem because it's not getting solved. I think if you see historically, whenever there is a problem in the US, they're usually fairly quick to act because I think the culture in US is, problem happens, act quickly, and then you don't keep on going back and forth. Well, I think in Euro, because given so many countries are involved and they've been going on for this for almost a year now, I think Euro will be more, ongoing, problem for the world as compared to US. So I think US will get handled fairly quickly, either one way or the other. Second is if US gets downgraded, I think it is bad for emerging markets for a couple of reasons. One is there will be flight to safety and a flight away from risky assets. So I think emerging markets as a whole, there will be some downturn on that in the short term. I think eventually the emerging markets where growth is there and on, money will start flowing back again. But in the short term, I think there will be flight away from emerging markets. And B, if there is a downgrade in the US, I think the probability of a QE3 or something like a QE3 goes up because US will have to try and do something to keep cost of capital down because once this downgrade happens, cost of capital will go up and it will have impact on the economic growth. And in order to counterbalance that, they will try and do some liquidity easing to bring cost of capital down. If that happens, as I said earlier, commodity prices could go up and it could be again bad for emerging markets. So I think we should all hope that the US downgrade is avoided at any cost, at least for the coming year or so.
Rashesh, for next 12 months, which are the businesses you think are looking slightly better and are looking slightly worse? Exporters, pharma, IT, or consumption-oriented sectors, FMCG, and to a great extent, autos?
I think consumption will continue to look good, especially, I think auto is still a little bit, interest rate sensitive, but I think other consumption will look good. I think things like pharma and all will look good, but I think export-oriented sectors, because if the rupee remains strong or the US dollar keeps on falling, the margin pressure on export-oriented companies might go up. But I think historically, export companies have shown that if there is a gradual, appreciation of the rupee, they are usually able to handle it well. So I wouldn't be extremely worried, but I think the risk of rupee appreciation for export companies will continue. However, I think for consumption-oriented companies, the market is still good as long as there is NREGA, as long as rural spending is good. I think for this year, agriculture should also do reasonably well. Consumption companies, especially FMCGs and others, and pharma should continue to do well at a very broad level.
Dinesh, would you advise our viewers to now start revisiting the beaten down infra and real estate space? Is it time to now pick up some stocks, some bargains from that wreck?
Yeah, definitely. We are bullish on infrastructure stocks. We feel that.
What do you like there?
Stock specifically it is very difficult because I would say for infra and capital goods, we would like to go for L&T, company like L&T, because we feel that whenever this investment cycle will return, company like L&T is going to benefit in a big way. So when we are talking about infra and real estate and all that, one has to be a bit careful because they have order book position which they have bid it at a very high price. So it will take a couple of years for them to really flush out this order. So they have learned their own lesson, but definitely for an investor, they will keep in mind that 4 or 5 quarters results would be bad. Till that time, they are able to flush that order out what they had taken during bad times. One has to keep in mind that when actually there was a hype in infra and real estate stock, at that time there was an easy availability of capital. So whatever project they have bid, they are not very profitable. And in this kind of scenario where interest rate is very high, they are going to suffer. So 4 or 5 quarters numbers would be bad. Though already they have corrected, I think it is in the price, but investors have to keep in mind, this is not a story which has to be bought today and after a year he says that, okay, I should get a good appreciation. If he wants to keep a permanent kind of some allocation to infra and real estate I think this is a good time to enter, stagger this investment, buy in small lots, and take this exposure in next 6 to 12 months and hold it for 2 to 3 years at least. Apart from that, I think where the valuations are looking for all other sectors, it appears that market is in a good shape for an investor to really buy. If you look at like our market, we are now actually confronted with positive news.
So the risk is on the upside.
Now government has started taking some policy decisions. We have seen decisions on mining and oil, FDI in retail. We are seeing some hopes now inflation will be under control. Food inflation was under control. We saw lowest growth in food inflation. Now with this US deciding to lower its consumption and reduce its fiscal deficit, I think these are positive news for India. And plus, I think icing on the cake is that valuations are very attractive. So for investors, I would say now all the sectors are very attractive. He has to be a bit careful, have a bottom-up approach, select good companies and make a good portfolio, and is going to make good profit if he has a time horizon of 18 months to 2 years.
Give us one large cap name and one mid cap name where you are convinced and you will tell your clients to buy that stock first thing on Monday morning.
Reliance, Axis Bank and United Phosphorus.
Why do you like United Phosphorus?
It's a market leader. Again, it is beaten down because of cyclicity, and I think market leaders available at a good valuation. We have seen they bounce back very fast. Monsoon has been good. So I feel overall, all the three companies will do well.
So why do you like Reliance? The business is not growing. There are multiple concerns for that stock.
Now, Reliance, one has to look at it this way, that company is good, it's available at a good valuation. This quarter result showed that they can achieve a growth rate of around 17%. There are issues. There are issues like they are unable to deploy their cash, incremental cash that they are generating in business. So, progressively they are thinking about going to go for debt-free status, which is not good for a commodity company. But we feel somewhere management will realize this is not a good strategy. They may come out with some kind of a strategy for buyback or maybe cancellation of treasury. That is going to give a big upside to this company.
Rashesh, I'm going to ask you a very big and a basic macro question. India is slowing down. Do you expect the GDP growth to slip below 7% or it's too early to assume that?
I think you might have a quarter here and there where because of the quarterly effect and all, you could be, but I think it's very unlikely. I think the current, the way things are with whatever slowdown we're experiencing, we should end up being somewhere between 7 to 8%, though you might have a quarter where it might be 6.85 or 6.9, but I don't think on a consistent basis we should go under 7 in the near future. So I think we are fairly okay, though I think you should understand India is a growth market. I think so if the growth rate is slowing down, then it's not as exciting as when the growth rate is improving. So maybe a slowdown of the growth rate coming between 7 to 8% will act as a base, and as it starts coming back and going back above 8%, I think it will be a fairly strong impetus for optimism and equity market, because in India people will pay for growth, but they will not pay for a sideways or a slowing down of growth.
Rashesh, you've always been a preacher of the word growth. Where are you convinced that growth is here to stay? I'm not looking at a stock, I'm not looking at a sector, I'm just trying to understand the growth, according to you, despite adverse macro and micro, will not slow down.
I think growth is there in India in various sectors. I don't think India is slowing down, because even at 7% real GDP growth rate, we should see somewhere between 15 to 20% corporate earnings growth rate. It will vary from quarter to quarter, but I don't see corporate earnings, going under 15% growth rate in a year. So I think growth is there in India. There are sectors like, I think the commercial banking sector. I do think maybe with interest rates going up, there is some NIM pressure, there is some NPA pressure. But overall, if you look at 5 years, I think consumption, banking, all of them, there is enough growth. Even the IT sector, I think growth is there. What is happening, Nikunj, is the growth rate of the growth rate is slowing down. The growth rate itself is not coming off. Only all the companies which are growing at 20-25% a year will grow at maybe 16 to 18% a year, which is also not bad. And also remember that if global growth slows down, Indian growth always looks good when global growth slows down, because even if you can get 7.5 to 8% growth in a world that is slowing down, we will look very good.
Dinesh, 30 seconds to respond. Between valuations, liquidity and earnings, what do you think will bail us out?
I think definitely earning would be a main positive factor. We have seen that in this quarter we saw bottom line growth for companies who have declared a result is around 17%. See, with all this backdrop that we had, that there will be slowdown, GDP is not going to grow at 8%. We are seeing 17% growth. So with this growth, I think definitely it will be a very attractive destination for foreign investors who have not invested a big money in India. I think if you look at FIS, they invest around 15 to 18 billion. And that is the pipeline that we are looking at. If there is a growth, definitely this money is going to come in.
Right. Rashesh, your discretion, how do you want to answer this one? What is your ultimate ambition for Edelweiss? Do you want to be the Goldman Sachs of India?
I think our idea is to build a broad-based financial services company that helps convert, the savings pool in India. We have a very high savings pool in India, help convert into investments, capital formation in a very efficient way. So I think our ambition is to be a platform between savers and the users of capital across all the products and the business platforms that we can have. I don't think any company can become another company. I think each company is fairly unique in it. Our idea is to be a broad-based financial services company, and we are hoping and fairly convinced that India will offer that opportunity in the coming 8-10 years.
Dinesh, 10 seconds. When are you planning to go public?
Definitely sometime, because I think right now valuations are not right, and we have definitely enough internal accruals to take care.
All right, gentlemen, good to have you on Each Now. Thank you for joining us. That's it on this special edition of Market Makers. Crash or correction, the verdict is very clear. The three men who matter the most, they are of the view that currently this is a correction. Investors should not panic. They should keep some degree of calmness, and they should pick up stocks on every decline. Thanks for watching the show. I'm Nikunj Dalmia signing off.